Welcome to Tech Talk Tuesday. I'm your host, Carla, and with me is my fellow co-host and CMT, David Blake. It's Monday, July 8th, 2024, and we have some activity to talk about that happened in the stock market last week, along with some interesting things to look out moving forward. We do it mostly from a technical perspective. David, I hope you had a great weekend. How are you doing today?
I did. Thank you.
Good to hear. Well, let's get started by taking a look at last week's market activity.
Okay, we had a good week in the market last week. In fact, it was one of the strongest weeks I think since March or April. We had the S&P and 500 and the Nasdaq. They notched a string of new record highs. I think they finished up the weekend at a record high also. We had a lot of news events came out. Basically, the big one was everybody was watching the June jobs report from Friday's Bureau of Labor Statistics. And that showed an increase of 206,000 payrolls, which was way down from previous month. But we also had unemployment rate rise to 4.1 from 4. So that's kind of ticking up a little bit higher. But it's kind of a bit of a Goldilocks number with jobs right now. The Fed wants to see a softening of the jobs market without seeing a big jump in the market. If you start to see the unemployment rate jump up to 4.5 to 4.6, then you know that they've held rates too high, and we're going to probably start to get talks about a recession and maybe already rolling into one at that stage. So as long as we can keep the payrolls up there, be above 150 to 200,000 that area, and keep the unemployment rate 4.2, something like that, we should be in pretty good shape on as far as a soft landing goes for the economy. We also saw some manufacturing data that was weaker than expected. The ISM manufacturing index was lower for a third consecutive month, and we saw a pretty big drop in factory orders too, which showed an economy that is still trying to stay on firmer footing, but we are seeing weakness in there across the board. Even in the services section, it's starting to fall a little bit lower. With all that, we did get a little bit of a boost from Fed Chair Powell on Tuesday before the holiday, and that was on the European Central Bank Forum. And he noted that he thought the FOMC, or the Federal Reserve, was actually making quite a bit of progress on bringing inflation down, but they needed to see a little bit more data before they would begin to cut rates. So that took, I think the 10-year Treasury was down something like 12 or 13 basis points, down below 4.3. I think it closed at 4.28. That's about where we are today. All we had today as far as economic data was the T-bill auctions, but we are getting a nice little pop in the market today to start the week. A couple of reasons for that we'll go into a little bit later, but right now we're up 170 points on the day. The Nasdaq's up 30 points, and we're getting a real nice little pop in the Russell 2000, the small caps, which have been lagging a little bit. Anyway, what's happening is we're seeing strength in the Magnificent Seven and the big cap tech stocks. And also last week we got a big jump in Tesla, which jumped about 25% on the week, which is absolutely amazing. I think it's up about 40% in the last 2 weeks. And the consumer discretionary sector was at the top of the leaderboard. It jumped 3.78% last week. That was mainly on Tesla, but Amazon also had a good week last week. I think it made a new high. You also had new highs made last week by Microsoft, Apple, Alphabet, Oracle. So that took the XLK, the technology sector, also to new highs. I don't think it ended Friday on a new high, but it hit a couple new highs during the week. As far as what was not working last week, we saw some lower prices on energy, healthcare, industrial materials. It's a little bit more cyclical there. So I was kind of surprised because energy actually being lower, we did see a little pickup in crude oil prices. We continue to see a little bit of expansion fears of the Middle East conflict, and crude closed around $83 or something a barrel. We'll see how that goes. It was been up now for 4 straight weeks. It's up about 14% from its low in June. So that's firming up oil stocks. As far as the week coming up ahead, we have kind of a busy week. Tomorrow we get Fed Chair Powell up on Capitol Hill. He's going to be giving testimony before the Senate Committee on Banking and Urban Affairs on Tuesday. And then on Wednesday, he does with the Banking Committee. He's going to testify a little bit on policy and the debt and all that kind of stuff. And I think you'll probably get a fairly dovish report from him. I think what's happening, you have July FOMC meeting coming up here in another week or so. And I think what Powell is basically trying to do right at this stage is to set the market up for a September rate cut. We went into Friday with the CME group FedWatch projecting almost an 80% probability of a rate cut in September. So it looks pretty good for that. And in fact, now I think it's something like a 75% probability that we'll get a rate cut, a second one in December to keep the market going. You're getting a lot of analysts right now and economists talking about that, we're getting to the level now where if you stay too much longer at these high rates, you're going to risk the chance that we've stayed a little bit too long. We need to start cutting a little quicker. And with the economy, when you start cutting and cutting rates and raising rates, the economy is kind of like a big ship coming in. You don't just decide, we're almost to the dock. We got to flip it to the right here real quick and try to park it. You got to start preparing for that bit of a turn, a little ways away from the dock. I think that's why what we'll start to see here is we'll start to see, them talking about a September rate cut, and they're going to try to ease into cutting rates here once or twice before the end of the year. They do not want to have it where all of a sudden, like we talked about the jobs, where all of a sudden you get a jump up to 4.5% unemployment, and then they go, we're too close to dock. We gotta cut rates at least 0.5% here real quick. So we're behind the 8 ball. So we'll kind of watch for that. And I think, over the next 2 weeks, you're going to see I'll kind of set the market up for a September rate cut. So that'll be pretty good. Now on Thursday, we'll get another inflation read. That's with the CPI. Currently, they're expecting 0.1% rise month over month. And I'm looking at two different numbers for year over year. Some are actually thinking that we could improve and go to 3.1% on the CPI year over year. That would be down 2 or 3 tenths from May. And some also are calling those, say we're going to be unchanged for the year over year. So I think if we come in somewhere at 3.2, 3.1, I think favorable for the market. If we get above 3.4 or higher, the market's not going to respond to that. And then on Friday, also on Thursday, we'll get earnings from Delta and from Pepsi. And then on Friday, we'll also have the money center banks beginning to kick off the earnings season. And I've noted that as I think it was Citigroup, Wells Fargo, and I think JP Morgan. Some of those we're hitting new highs on Friday. So we are looking for some lofty numbers in the banks, and we don't want to hear that people are fudging on their loans, that type of thing. So it'll be a fairly busy week.
Okay, and how is the technical condition of the market doing?
As far as the market goes, the technical condition of the market remains positive. We have the S&P 500 NASDAQ close on Friday, and they're overbought by several measures still. The MarketEdge S&P short range oscillator is not overbought yet, but that's looking at more than just the S&P 500 and NASDAQ. That's looking at the Dow and transports and the small caps, and they've been lagging the secondary indexes, and actually so has the Dow. Playing a little bit of catch-up ball today with the Dow outperforming. Also getting some outperformance today by small caps. Like I said earlier, the Russell 2000 is up 22 points, up 1.1%. It did climb back above its 50 and 100-day moving average, that bodes well for the market going forward. So we want to see what happens there. That would indicate, if we can see that maybe we're getting a little bit more of a broadening out. We don't see that quite yet. I mentioned in the letter that the NYSE and NASDAQ advanced decline lines are considered leading indicators of market direction, mainly the NYSE. The NASDAQ, not so much, but the NYSE was up. You're talking about being up like 300, 400 units for a week. A good week on the AD line would see it up 2,500 units, something like that. Now, I did mention that one caveat is that we're actually only about 2,000 units off the previous high on the NYSE AD line, which came about, what was it, mid-May. And normally these AD lines will top or bottom and turn before the market does. So that's why we consider them leading indicators. In other words, when the market's going down, if you watch that AD line, all of a sudden you'll start to see it flatten out and then start to go up as people start to nibble away, trying to catch a bottom. And we'll see that move ahead of the trend of the market before it changes. So we're kind of watching that very closely. Again, like I said, we're having a pretty good week start to the week. We'll see how it finishes up. But we want to keep an eye on those new 52-week highs are mixed. We have more new highs and new lows on the NYSE, more new lows and new highs on the NASDAQ.
And how are we looking for investor sentiment?
We also have bullish sentiment is not off the charts, but it's getting there. We have the highest jump in margin levels in May, 809 million. That's the highest level since February 2022. So that's something to watch. The hedge funds are also back on margin. They jumped from like 88% or something like that up to 103.7. That's the most exposure to equities they've had since the last week of March. And then continually we see the retail investor. They're more bullish than what they are historically. In fact, I think we now have something like 35 out of 36 weeks the retail investors been above the historical norm. So a lot to watch out for there. Even the percentage of investment advisors is almost 4-1 more bulls than bears. So these are just things you have everybody on the same side of the trade. That is the kind of stuff that you take notice of. That doesn't mean it's not a sell signal in itself. It just means that the danger of that could be if everybody's is long and something happens where there's a little bit of a panic and everybody decides to get out, you'll have too many people getting out. That's going to have the market sell off more than it normally would. So that's why contrarian indicators are a little bit of a problem. So anyway, I think the market, we should be okay this week. Kind of watch these big events with testimony. Again, I think Powell wants to set it up for things are looking good. Maybe that they're making progress. See how the CPI comes in, see a little bit more progress on inflation. Then we'll see how the earnings start to roll out here on Friday. And I think that should be keep us moving sideways to maybe with a little bit of upward push.
Okay, well, that gives us a few things to take a look at. And you mentioned that tech and consumer services and also the consumer discretionary sectors are doing very well. Are they still looking to lead the market higher going forward?
It kind of looks like it is because basically those sectors are still, at the top where they're making new highs. Even today, today we have the consumer discretionary is up a little bit. Tech is leading the market again. Mainly that's because of semiconductors. Semiconductors today are up another 1.5%. Even with this pullback that we've had in Nvidia today, you're getting stocks like Intel and some of the other things like that. They're starting to get a little bit more. They're starting to outperform. They're playing a little bit of catch-up ball, and that's something that you want to keep on going. The SOX keeps on making new highs, and I think that's sometimes we're seeing some backing and filling in the software stocks. A lot of that, some of that I think is due to some regulation. That's something you want to kind of keep an eye on. But as far as the semiconductors go, just doesn't seem to be any stopping them at this stage.
Considering that the CTI is projected to pull back as early as next week, which the CTI is a proprietary market forecasting indicator on MarketEdge, how long can we expect a negative CTI configuration once that happens?
I do think that we'll probably see the market pull back here, probably starting in August for a little while, just because of uncertainty. And also, again, because you're starting to see the economy slow down. I think investors want to see how slow it's going to go. But other than that, I wouldn't worry about the election all that much what's going to do to your investments.
Okay, well, that's good information to know. We are actually almost running out of time here for this week, but is there anything else that you would like to add moving forward?
No, I mentioned it again. We'll listen to Powell and then CPI on Thursday, and we'll watch the earnings start to roll out on Friday. And I think, I do think we are getting close to a midterm top in here. I think you're going to kind of have some choppy trading going after this week should be good, but after this, generally towards the end of July is when historically and seasonally you start to see the market pull back. August usually is not a very good month for the market. I think that we'll see some see some choppy trading with a downward bias probably after this week.
All right. Well, we will definitely keep an eye on that. Well, David, thank you for all of the helpful information. I think we have a pretty good episode for this week's Tech Talk Tuesday. Thank you to all of our listeners, and we hope you have a great week.
You got it. Thanks, Carla. Bye-bye.